This is the time of year for stock market predictions. If you read Barron's, you probably saw their Barron's Roundtable that just came out. You see, every year, Barron's interviews 10 Wall Street experts. And this year, every single one of them is predicting that the stock market is going to go up in 2017. Not a single one of them has any doubts about the market going up. None of them can think it can drop. That's nice to know. I could throw a number out of a hat too about where I think the market's going to end up on December 31st, 2017. But really, that wouldn't help you make any money in the markets this year. What would you do with that type of information? And I'm not talking about making a little bit of money. I'm talking about how would it help you beat the market. Because at the end of the day, that is what this stock market game is really about. You see, what you need to ask yourself now is what is really going to make the difference between being a winner in the stock market or being a loser by the end of this year. More important to have in your hand is not some random number predictions for the S&P 500, but to know and to understand what is going to be the real driving factor that is going to define the stock market this year. You see, if you can know that and understand that, then you will know what to do to beat the markets this year and come out a winner. And that's what I'm going to show you in this video. But to start, let's look back at what moved the market in 2016 to the surprise of just about everyone. Of course, that was the election of Donald Trump. Now, I wasn't shocked that Trump won. I was surprised. I knew it was possible, but I was shocked that he won in an electoral college landslide. And I was surprised that the Republicans took control of Congress the way they did. And so, the day after the election, I made changes in my own portfolio. I was short stocks going into election day, meaning that I was actually betting against the stock market at the time. I had built up a big short position in August and September, and the market did dip in the election, but afterwards I closed those positions all out and I moved my money into Trump-favored sectors. I ignored the tech stock fads like Google and Facebook and moved my money into banks, infrastructure, and transportation plays. And they all rallied and rallied. And they helped to make the Dow go up towards 20,000 because they have a heavy weight on what moves the Dow. No one could deny that Trump shook up the world and moved the markets. A lot of people were happy with Trump's win, but yes, it did make some people freak out. Some Democrats really got upset and they freaked out. People were demonstrating in the streets. But the world, it didn't come to an end, and things, they did calm down. But something interesting happened on December the 14th at the Trump Tower in New York City. On that day, top executives from Silicon Valley met with Donald Trump at his Trump Tower. Many of them had opposed Donald Trump, and many of them had been huge donors, in fact, to Clinton during the election campaign. Most of them make their products overseas, and so they profit from the low-wage labor and didn't really like his talk about criticizing free trade deals. And a lot of them oppose him on cultural issues too. But I really think it's economics. When the BBC sent a team to Apple's China factories, they found children working in them going through hell. They found that the workers are not allowed to even go to the bathroom for breaks. And some of them were even peeing in their pants while they're working because of that. They found that when they asked to take a break for a day or half a day after working for 12-hour shifts 18 days in a row, they would be denied. And in these type of sweatshops like this, workers can be beaten or even killed if they attempt to organize themselves into a union. The Silicon Valley CEOs simply don't want these free trade deals disturbed. That's the cruel reality they won't talk about on CNBC, because they're using the low wage labor in these countries and working conditions to literally milk the life out of these workers to make more profits. Right or wrong, whatever you think of Trump, he's promising to upset all sorts of apple carts all over the place. But here's the thing, despite all that, most of them actually came away from this meeting with Trump happy. One person, in fact, left it saying that Trump seemed to be, quote, reasonable and fair the whole time. But one person in the corner, in particular, seemed to be very uncomfortable at the meeting. And this was Jeff Bezos of Amazon.com. Bezos also owns the Washington Post. It had been running non-stop attacks against Donald Trump during the election. In fact, he's still attacking him. So maybe that's why he squirmed a little at the meeting. Or perhaps he's worried about the Amazon stock share price. You see, Amazon insiders have sold millions of shares of stock in the past 6 months. Insiders are people that own 5% or more of a company in the outstanding shares. And Bezos himself had been dumping. And even institutions on Wall Street have sold 2.54% of their own holdings too. Amazon just got to a silly valuation level. The thing is, Amazon stock has actually been falling even though the Dow went up going into the end of the year. Look at the chart. You can see that Amazon has been going nowhere now for the past several weeks. It's also formed a triangle chart pattern. This is a topping pattern, and Amazon shares just broke below support on the last trading day of 2016. This suggests to me that it's getting ready to dump. Just so you know, I actually put on a small options play against Amazon in one of my accounts. And if you're interested in betting against Amazon yourself, that's what I'm doing in my options play. You might want to take a look at the March 17 puts that have a strike price on them of $750. They last closed for $39.40 on the last day of 2016. Now, nothing's guaranteed, but I think Amazon stock's going to fall over the coming weeks, and I think these puts are going to go up in value. The thing is, though, that's really important for you to know is that a lot of stocks right now have charts just like what you are seeing right here for Amazon, and they look like they're going to pull back over the coming weeks. In fact, almost every single stock in the NASDAQ 100 looks like this right now. You can look through them all yourself to see. In fact, you probably should do that. But if you don't have the time, here's one. Take a look. This is Facebook. It's already down since Trump's election. And the fact of the matter is that a lot of the most popular big cap tech stocks are now trading like crap. That's how they ended going into the year. And while most of these Trump favored sectors rallied like crazy after election day, so many of the big cap tech stocks have done nothing. And this is a bad sign for them for the next couple months. In fact, the way so many of them look, it makes me pretty sure that we're going to see the stock market pull back in the first quarter of the year. That's nothing to be scared of. Pullbacks happen all the time. Usually there's one every year. And last year, the S&P 500 fell down to its 150-day moving average 3 times. And the thing is, a market drop will bring us a great opportunity to do some strategic buys. And understanding what is to come and what's likely to happen enables us to get ready now so we can take advantage of things as they unfold. And so, I have raised up some cash in my own accounts to get ready to buy later because I think it's just a smart, prudent thing to do to start this year out. And really, the only way to be able to buy a dip later on when one happens in 2017 is to make sure you have cash on hand. You do not want to be fully invested now and remain that way, because that will make buying later impossible. So yeah, I don't think anyone should be fully invested in the stock market at this moment after the big rally and with the signs we're seeing in these tech stocks. They need to have cash reserves to be able to buy later. Think back to what happened last year. Last year, the stock market dumped in January to start the year off, and it fell into February. People who came into the market fully invested in January 2016, all they did to themselves was suffer during that drop. If instead they'd come into that year with some cash on hand, they could have watched the drop play out and then bought as it came to an end. So turn back the clock. I think we're setting up for a similar type of opportunity now. But this is not the most important thing that's going to define the coming year. Let me ask you this. Do you think it's really possible to beat the market in 2017? Because it's been difficult for a lot of people. And for a reason. Here are some stats. In 2016, the S&P 500 finished the year up 9.77%. However, the average hedge fund simply failed to beat the market. And most of them weren't even up 6% by the end of the year. Now, in case you're wondering, I did manage to beat the market in my main account and almost all my accounts. I got one small account that didn't do it and another one I just opened up that I haven't done much with yet. But what's important is this. The NASDAQ 100 only went up 5.9%. So it couldn't beat the S&P 500. And the thing is, most people are now more invested in the stocks of the NASDAQ 100 than anything else. You see, it's Apple and Amazon and Facebook and Google and all these big cap tech stocks that were the big winners in 2014 and 2015 that became super fads due to that fact. And so everyone got into them thinking that they just go up and up and up and that would continue. And instead, they became big laggards by the end of 2016. And that's why when the Dow went up to 20,000 after the Trump election, most people really didn't make much money on that move. They're simply invested in the wrong stuff. They're invested in stuff that was red hot before, but no longer is. These were all past fad stocks. And they didn't move their money into the stocks that were leading on the Trump rally right after the election came. I did, and that's really one of the biggest reasons I was able to beat the market average in 2016. Now, my prediction for 2017 is that focusing on the right sectors of the market is going to be more important than ever now going forward. The reason why this is going to be the case is very simple. The stock market started a bull market in 2009. At the very start of a bull market cycle, everything goes up and things can go up huge. As a market cycle goes on, though, things start to change. And things really start to change once you get into the last couple innings of a stage 2 bull market or even into a stage 3 topping cycle. A stage 3 topping cycle, they can last a long time, but when they happen, only a few sectors continue to go up, while almost everything in the stock market stagnates. Now, I'm not saying everything's going to crash. I'm just saying we're likely to get a pullback in the first quarter of this year and prepare for it and take advantage of it. And it doesn't matter if we're in stage 3 or late in stage 2, that's still going to be the case. And what that means is that from now on, only a few sectors are going to lead. And what's leading now is actually changing. So the past fads, so many of them are now fading and fading fast. The bad thing about it, the sad thing about it, the thing that isn't right about it is this is making some people actually come to think that they can't beat the market, that something's wrong with them. But that's not true. So yes, it's true that it's hard for most people to beat the market, but that doesn't mean you can't beat the market. The key is deciding to be a market winner and deciding to do the work and being on top of things that's necessary now, late in a bull market or in a stage 3 market, to be in that situation. And what that requires is an understanding of how to identify future leading sectors. That understanding is now going to be the key to winning in the markets going forward. So forget about predictions about what price level the S&P 500 might end up on December 31st, 2017. The dominant factor in how you do in the markets going forward now is whether you're going to buy the winning stocks in the winning sectors, or if you're going to be in the bad ones that were once hot 2 years ago but are now fading fads. And I want to do everything to help you get in that situation. So tomorrow, I'm going to send you a video to show you how you can find yourself the winners and avoid the losers. I'm going to show you how you can find these things out for yourself and not have to depend on anyone or any expert. So just check your email box tomorrow, because in it you're going to get an email from me with a link to a video that's going to be a game changer for you in the markets and show you how to do all these things. Just watch the video and look for it tomorrow, and I'll talk with you again.